What is personal finance?
Personal finance refers to the management of an individual's or household's financial activities, including budgeting, saving, investing, and debt management to achieve financial goals and security.
What are the key pillars of personal finance?
The key pillars are earning income, budgeting expenses, saving money, managing debt, investing wisely, and planning for retirement and insurance needs.
What is a budget?
A budget is a financial plan that estimates anticipated income and allocates it to expenses, savings, and debt repayment over a specific period, typically monthly.
What is the 50/30/20 budgeting rule?
The 50/30/20 rule recommends allocating 50% of after-tax income to needs, essentials, 30% to wants, discretionary spending, and 20% to savings and debt repayment.
What is net worth?
Net worth is calculated as total assets, cash, investments, property, minus total liabilities, debts, loans, providing a snapshot of financial health.
What is an emergency fund?
An emergency fund is a cash reserve covering 3 to 6 months of essential living expenses to protect against unexpected events like job loss or medical emergencies.
What is the difference between a checking account and a savings account?
A checking account is designed for frequent transactions with low interest and check writing capabilities, while a savings account earns higher interest but limits withdrawals to promote saving.
What is compound interest?
Compound interest is the interest earned on both the initial principal and previously accumulated interest, leading to exponential growth over time. It's often called interest on interest.
What is simple interest?
Simple interest is calculated only on the original principal amount, resulting in linear growth without compounding effects.
Why prioritize paying off high-interest debt?
High-interest debt, like credit card balances at 15 to 25% APR, grows rapidly and consumes income. Eliminating it first saves money and boosts financial flexibility for saving and investing.
What is a credit score?
A credit score is a 3-digit number, typically 300 to 850, that summarizes creditworthiness based on payment history, credit utilization, and other factors used by lenders to assess risk.
What are the main factors influencing a FICO credit score?
Key factors include payment history, 35%, amounts owed/credit utilization, 30%, length of credit history, 15%, new credit, 10%, and credit mix, 10%.
What is the difference between good debt and bad debt?
Good debt builds wealth or improves earning potential, e.g., mortgage, student loans, while bad debt finances depreciating assets or consumption without returns, e.g., high-interest credit card debt.
What is a credit card?
A credit card allows borrowing up to a limit for purchases, repaid monthly. It builds credit if used responsibly but incurs high interest, APR 15 to 25%, if balances carry over.
What is a secured credit card?
A secured credit card requires a cash deposit as collateral, which sets the credit limit, making it ideal for building credit with poor history while minimizing issuer risk.
What are student loans?
Student loans are borrowed funds for education expenses, with federal options offering fixed rates and forgiveness programs, versus private loans with variable rates and stricter terms.
What is a mortgage?
A mortgage is a loan secured by real property to purchase a home, repaid over 15 to 30 years with principal, interest, taxes, and insurance, PITI.
What is investing?
Investing involves allocating money to assets like stocks or bonds with the expectation of generating income or appreciation over time, balancing risk and return.
What is the risk-return trade-off?
Higher potential returns generally come with higher risk. Conservative investments like bonds offer stability but lower gains, while stocks provide growth potential with volatility.
What is diversification in investing?
Diversification spreads investments across asset classes, sectors, or geographies to reduce risk, as poor performance in one area is offset by others.
What are stocks?
Stocks represent ownership shares in a company. Common stocks offer voting rights and dividends, while growth depends on company performance and market conditions.
What are bonds?
Bonds are debt securities issued by governments or corporations, paying periodic interest, coupon, and returning principal at maturity, generally lower risk than stocks.
What is a mutual fund?
A mutual fund pools money from investors to buy a diversified portfolio managed professionally, offering accessibility but with fees and potential underperformance versus indexes.
What are ETFs?
Exchange-traded funds, ETFs, are baskets of securities traded like stocks on exchanges, providing diversification, low fees, and intraday trading flexibility.
What is an index fund?
An index fund tracks a market index like the S&P 500, offering broad exposure, low costs, and passive management that historically outperforms most active funds long-term.
What is a 401k plan?
A 401k is an employer-sponsored retirement account allowing pre-tax contributions up to $23,000, 2024, often with matching, growing tax-deferred until withdrawal.
What is an individual retirement account, IRA?
An IRA is a personal retirement savings account with annual contribution limits, $7,000 in 2024 for under 50, offering tax advantages based on traditional or Roth types.
What is a Roth IRA?
A Roth IRA allows after-tax contributions with tax-free qualified withdrawals in retirement, ideal for those expecting higher future tax rates or brackets.
What is a traditional IRA?
A traditional IRA offers tax-deductible contributions and tax-deferred growth, with withdrawals taxed as ordinary income, suited for current tax savings.
What are tax brackets?
Tax brackets are income ranges taxed at progressive rates, 10% to 37% federal in 2024. Only income within each bracket is taxed at that rate, not all income.
What are tax deductions?
Tax deductions reduce taxable income, e.g., mortgage interest, student loan interest, lowering tax liability. Standard versus itemized options apply based on total.
What is inflation?
Inflation is the rate at which prices for goods and services rise, eroding purchasing power. Target around 2% annually prompts saving and investing to outpace it.
What is the time value of money?
The time value of money states $1 today is worth more than tomorrow due to earning potential. Discounted cash flows quantify future values in present terms.
What is opportunity cost?
Opportunity cost is the value of the next best alternative foregone when making a decision, like choosing to spend on dining out instead of investing.
What is asset allocation?
Asset allocation divides investments among stocks, bonds, and cash based on risk tolerance, age, and goals to optimize returns while managing risk.
What is dollar cost averaging?
Dollar cost averaging invests fixed amounts regularly regardless of price, reducing timing risk by buying more shares when low and fewer when high.
What is portfolio rebalancing?
Portfolio rebalancing adjusts asset allocation back to target percentages periodically, e.g., annually, by selling outperformers and buying underperformers to maintain risk levels.
What are capital gains?
Capital gains are profits from selling assets at higher prices than purchased, short-term, under 1 year, taxed as income, long-term at lower rates, 0 to 20%.
What is health insurance?
Health insurance covers medical costs via premiums, deductibles, and copays. Key types include HMOs, network restricted, and PPOs, flexible with higher costs.
What is term life insurance?
Term life insurance provides coverage for a set period, e.g., 20 years, at low premiums, paying beneficiaries only if death occurs during the term.
What is disability insurance?
Disability insurance replaces income, 50 to 70%, if unable to work due to illness or injury, with short-term, weeks, months, or long-term, years to retirement, options.
What are the pros of renting versus buying a home?
Renting offers flexibility, no maintenance costs, and lower upfront fees. Buying builds equity and offers tax benefits but ties you down with higher costs and risks.
What is a down payment?
A down payment is the initial cash portion of a home purchase, typically 3 to 20%, reducing loan amount, interest, and need for private mortgage insurance, PMI.
What is private mortgage insurance, PMI?
PMI protects lenders on conventional loans with less than 20% down, costing 0.5 to 1% of loan annually until equity reaches 20%.
What is a 529 plan?
A 529 plan is a tax-advantaged savings account for education expenses, with growth tax-free if used for qualified costs like tuition. State-specific benefits vary.
What are SMART financial goals?
SMART goals are specific, measurable, achievable, relevant, and time-bound, e.g., save $10,000 for emergency fund in 12 months via $833 monthly deposits.
What is a sinking fund?
A sinking fund earmarks money in a dedicated account for predictable future expenses, e.g., holidays, car repairs, preventing debt accumulation.
What is a common behavioral finance bias?
Confirmation bias leads to seeking information confirming beliefs while ignoring contradictions, often causing poor investment decisions like holding losing stocks.
What is estate planning?
Estate planning organizes asset distribution after death via wills, trusts, beneficiaries, minimizing taxes, avoiding probate, and ensuring wishes are followed.
What is the difference between a will and a trust?
A will dictates asset distribution after death but goes through probate. A revocable living trust avoids probate, offers privacy, and manages assets during incapacity.
What is tax loss harvesting?
Tax loss harvesting sells losing investments to realize losses offsetting capital gains taxes, then repurchases similar assets to maintain portfolio allocation.